Attention investors, if you plan on purchasing a commercial property using a loan, you're definitely going to want to stay tuned for this video. Today we're going to discuss how lenders view asset classes and how knowing this information is definitely to your advantage. Let's break it down. To a lender, when it comes to asset classes, that actually equals risk. And at the end of the day, we all know risk definitely plays a role in your loan. First up, we're going to start with asset class A. Super simple. You're going to find that most banks view this as actually a low risk investment. And with that being said, you're going to find that you're going to get sweeter terms, better interest rates, and at the end of the day, you may have an opportunity to have higher leverage. Next up is asset class B. Now, when it comes to lenders, they're going to see these as super solid investments. But with that being said, they're going to be hyper focused on the tenants and, more importantly, the operations. Next up is asset class C. Now you have to understand this. This is where it gets a little risky for the lender. So with that being said, when it comes to underwriting, yeah, they're definitely going to scrutinize this deal, and it's going to reflect in your interest rate. It's going to reflect in your terms. It's going to reflect in your leverage. It's a riskier deal. They'll do the deal, but you have to understand you're going to pay some more money. Next up is asset class D. All right, check this out. These are super risky deals. Yes, there are some lenders that won't even do the deal at all because it's too risky. And for those lenders that are willing to do the deal, they may want you to put a big down payment so that you can help offset that risk. Here's the key to the video. If you misclassify your asset to begin with, then that means your financing options, those are going to fall apart. At the end of the day, it's best to think like an investor, but also like a lender.